Greetings, my dear friends. As we discussed the first five chapters in the previous book, let's talk about chapter 6 in this session. So, the chapter is about portfolio policy for the enterprising investor negative approach. Enterprising investors seek higher returns, find guidance in chapter 6. This chapter introduces a negative approach to filter out unsuitable investments. Graham expands on the enterprising investor's mindset, urging investors to be discerning and deliberate in their stock selection. This chapter emphasizes the importance of selective approach for enterprising investors, setting the stage for the pursuit of higher returns through a focused investment strategy. Very importantly, negative approach for the for excluding the companies is very important as a part of this chapter. The next chapter is about portfolio policy for the enterprising investors approach. Enterprising investors positive approach. We talked about the negative approach. Now we talk about the positive approach. This chapter continues the exploration of the enterprising investor mindset now with a positive approach. Graham emphasizes the need for thorough research and analysis in evaluating potential investments. Enterprising investors are encouraged to explore a wider range of securities, including those with growth potential in or out of favor sectors. This proactive and informed approach defines the enterprising investor strategy, allowing for a broader scope of opportunities. Very interesting. We talked about the negative approach, now we talked about the positive approach. Let's move to the next chapter, investor and market fluctuations. Chapter 8 introduces us to the enigmatic character of Mr. Market, a metaphor illustrating the market's emotional and often irrational behavior. Graham advises investors to capitalize on Mr. Market mood swings by maintaining discipline and emotional control. This chapter delves into the psychological aspect of investing, emphasizing the importance of emotional control in navigating the inevitable fluctuations of the market. As we all know, market is bound to fluctuate, and it is our responsibility to keep our emotions in check, which is very important for us to, I don't say win the market, but at least stay in the market and grow in the market. Chapter 9 talks about historical valuation insights. This chapter takes us back in time, examining historical stock market trends leading up to 1972. Graham provides insights into valuation levels, market cycles, urging investors not to assume that current market conditions will persist indefinitely. If you remember, we talked about slightly about the historical market trends in the previous session, and this chapter emphasized the importance of recognizing the cyclical patterns and approaching the market with cautious and objective perspective, considering historical context in the investment decisions. The next chapter is about the investor and his advisors. When I say advisors, it's financial advisors. Chapter 10 explores the intricate relationship between the investors and financial advisors. Graham advocates for maintaining skepticism, being independently minded, and prioritizing investor education when seeking financial advice. This chapter encourages investors to be proactive in their financial decisions, viewing advice as a complement to, rather than a substitute for, their own understanding. As we all know, we have been one or the other day, we were been contacting the financial advisors as vice versa, but we should be very critical of those advice and please be cautious. Thank you. That's all, my friends, and have a great day. Jai Hind. Let's talk about something in the next five chapters in the next session.